Madam Clerk, we'll go ahead and call the meeting to order. Clerk, please call the roll.
Calling the roll, Mr. Greenspan.
Here.
Mr. Miller.
Here.
Mr. Jones. Mr. Jones is absent. Mr. Harrison.
Here.
Mr. Gallagher.
Here.
Mr. Strawn.
Here.
Ms. Brown.
Here.
We have a quorum, and I'd like the record to reflect that Mr. Brady, Ms. Conwell, Mr. Germana, and Ms. Simon is in attendance.
Great, thank you. Thank you, everyone, for their attendance. This is the Cuyahoga County Finance and Budgeting Committee meeting. Before us, we have the minutes from the March 16th meeting. If there are any amendments or adjustments, I'll entertain them. If not, I'll entertain a motion to approve the minutes as submitted.
So moved.
Motion's made. Is there a second? Motion's made and second. Any discussion on the motion?
No.
Hearing none, all in favor of approving the minutes signify by saying aye.
Aye.
All opposed? The minutes are approved. Matters referred to committee, we have none. We have one item of miscellaneous business. If the clerk will just read that title.
Discussion of the county's finances, budget, and debt capacity.
Great, thank you. I want to just refer everyone, my colleagues, as well as those in attendance, that we have an extensive agenda package that's been put together. And in the package, among other things, is a memo from me, and I'll read a brief portion of it. Also, is a table of contents containing a number of exhibits that council staff, the administration, and myself have put together various documents. They're contained. Page 14 is the table of contents, and beyond that are the related exhibits, which I'll be referring to during various portions of today's committee meeting. I'll go ahead and read briefly the statement that I prepared regarding the purpose of this meeting. Section 301 of the Charter empowers the County Council as a legislative and taxing authority of the county and as a co-equal branch of the government with the executive branch. Thus declaring the co-equal branch of county government, the Charter enacts the checks and balances relationship of the legislative branch to the executive branch and vice versa. Accordingly, the Council is within its purview to question, review, and verify financial, operational, and/or policy initiatives, statements, or programs of the executive branch. The Finance and Budgeting Committee meeting has been called to discuss a few very finite finance and debt issues. On March 26, 2015, the County Executive Budish stated in a press conference that the county is facing, quote, serious situation, end quote, as it relates to its financial health. It's my intent as chair of this committee and as member of this council not to conduct a hearing or a meeting for the purpose of being adversarial or contradictory towards the administration, but to simply better understand the statements made during the press conference, as well as information presented to council that it relied upon in making its decisions over the past four weeks and months. This meeting is a culmination of and collaboration of council members, its staff, members of the Office of Budget Management, as well as outside consultants to the county. To review the progress the council has made and the steps that have been taken to bring us to this point, we have, and I've listed, and each of you has a copy of the various reports that were used, and they're so contained in the exhibit. This meeting will be conducted in a very orderly, professional, and deliberate manner. The agenda has been prepared to address very specific topics, and once each subject matter has been dispensed with, we'll move on to the next subject. After each presentation is concluded, a question and answer period will be afforded each member, and each member will be able to ask up to 3 questions per round of Q&A, and we will hold as many rounds of Q&A per subject as needed. We may hold additional hearings in the next couple of weeks if necessary. So as I stated previously, we've divided the agenda up into various topics. There are a number of topics which were addressed in the executive's press conference, and we'll address them. A number of members of council as well as staff submitted questions to the administration, which we received answers this morning. And we'll have Chris Murray come forward and move through each of the topics. The first topic that we'll address will be the discussion regarding the 27th pay reserve. So, Mr. Murray, what I'd like you to do is address the committee on the questions that were asked relating to the 27th pay, and those were contained in question 2 of the list of questions submitted to the administration for response.
Thank you, Councilman Greenspan. Good afternoon, members of the Finance Committee and members of Council. Chris Murray, Office of Budget and Management. In terms of the 27th pay issue is related to, I guess, in terms of differences in the reporting structure of our OBM schedule of reports.
Let me ask you this. I may interrupt from time to time, but just to give a brief overview of the purpose of the 27th pay and what we're talking about.
All right. The 27th pay is a financial mechanism, essentially every 11 years, because of the biweekly nature of our payroll. We have a year where we have one additional pay, and essentially this happens every 11 years. In terms of the way we've handled this or administrated this in Cuyahoga County is we've set aside general fund resources each year to cover the 27th pay. So essentially we take 11 years and we slowly build our general fund reserve balance to cover this expense. So in 2015, we will need to appropriate one additional pay. The appropriation of that pay is going to be determined based on our current payroll at that time. We could have easily divided our current budget by 1/26 and then just added that as a part of the 2015 appropriation measure. But I thought it would be more prudent if we waited. We have these reserves set aside, so the resources are there for this appropriation. But I could give you a better number for what that actual 27th pay will be based on our current year activity, analysis of vacancies, field positions, anticipated positions. All of that would be incumbent upon a 27th pay forecast. So the plan for the Office of Budget Management was to bring forward a recommendation for that 27th pay around the mid-year time frame, and then we could discuss that along with any other formal budget actions that we would contemplate during the mid-year review.
Okay, thank you. I'll entertain questions from my colleagues. I've got a number of them, but I'll defer. Any questions? Okay, let me start with from a presentation perspective, and I'm going to go back into the package on page 18, Exhibit 2, which was the approved budget that council approved at the end of 2013 for the 14 and 15 budget. And what we've done is we've actually highlighted the 27th pay reserve as an item in the 2013 budget, which rolls forward into the 2014 beginning budget. Correct? The reserve
that you've highlighted.
Yes.
It rolls forward in the balance.
Correct.
Right.
Correct. So the statement that the 27th pay was not accounted for may be a matter of semantics in the sense that the general population may read that statement that council was unaware and that the administration in itself and the county government was unaware that the 27th pay was coming. So the more correct assertion is that the 27th pay was anticipated and so reserved. Correct?
That is correct.
Okay, so to say it wasn't accounted for may not be, it's semantics, but it's definitely, clearly indicates by this document and what you just stated and what we believe to be true is that we were made aware and the administration was aware that 27th pay was coming and funds were reserved.
Yes, funds were reserved.
Okay.
Again, we're talking about the difference between columns on two separate reports. But I assure you, the 27th pay is anticipated.
Okay.
It has to be formally budgeted, but the 27th pay resources are there.
Okay. And even going so far as to look at Exhibit 4 on page 20, which was the final financial statement that general fund that we received on December 12th of last year, the 27th pay was even reserved and presented there and rolled forward into the 2015 budget. Is that correct?
Yes.
Okay, so not only did we see it in 2013, and I didn't go back to look into the previous budgets, not only that we inherited when we took over this new government, but the budget, the original budget that was prepared by this county during our first 4 years in office, but it also was presented in 2013, and it was further stated to us again in as late as 3 months ago, well, now moving into the fourth month in December, that money was still reserved. And if you look and follow the ideology of the budget, it was not only reserved, but did continue to roll forward into the 2015 final budget column. Correct?
Yes, it is in the 15 final budget column. I think again, what we're talking about, we're making distinctions between the 2015 final budget, which has projection columns. This is probably getting into more OBM parlance than you would like, but they are projection columns, and then there's budget columns, and then there's year-to-date actual columns. So I think some of the confusion or the discrepancy was based on which report you were looking at that moment.
And let me ask you, since we're still on Exhibit 4, in the operating expenditure category leading up to the total operating expenditures of $334 million, and once again we're just talking general fund, when that budget was compiled, was the 27th pay expenditure anticipated in those expenditure related numbers?
It is not in the operating expenditure budget as passed, correct.
So why, if we knew, and this report even reflects the 27th pay as being a reserve number and the cash being so reserved, why then under the expenditures wasn't the 27th pay anticipated, or I shouldn't say anticipated, we've acknowledged that it's been anticipated, why was it not reflected in the budget? Well, so you're saying this budget includes 26 pays, but we knew the 27th pay was going to be made in December, in 2015. Why was that?
The budget expenditures include 26 pays, correct.
Why not 27 if we knew we were going to pay it in 2015?
The 27th pay, that number, that $11 million, that's an estimate. I believe that is our total county impact. Total estimated impact for the 27th pay. I think that essentially that became a call for me. I didn't think that. I thought that since this was a 27th pay and it's an extra, it only comes around every 11 years, so as not to over appropriate that expense, I could take a better look at that 27th pay, bring it to council during the mid-year review process where we formally bring you mid-year adjustments. I thought that would be a better number than a number that I came up with in the fourth quarter of 2014 in this case.
But let me ask
that was my call.
So let me ask you this. So if we knew revenue was roughly $390 million, and this budget reflects total expenditures, we'll include other financing, at $287, right? So we have basically a $3 million, what says the bottom, $3,032,000 surplus. But that does not include $8.5 to $11 million worth of expenses. Is that correct?
That is correct.
So in essence, then the based on the information we were presented, we were anticipating adopting a budget that was with either operating at a surplus or within a tolerable level of being pretty close to now looking at a budget that the administration was aware had $8.5 to $11 million worth of expense not included. So effectively,
what I would say to you is this: the $386 million that is currently budgeted. If you look at the history of the county, we do tend to underspend.
No, I understand.
We tend to underspend that, and then again, you're looking at, if we look at revenues that are based on our 2014 projection with associated increases, that the surplus that we're talking about, I think it's going to be considerably larger.
Okay.
from an operating surplus
All right.
perspective.
There's a point I want to come back to,
Right.
and we'll get back to it later. It has to do with our historical expense spend versus what's budget. But Councilmember Simon has a question.
Thank you, Mr. Chair. My question from a council person standpoint, as well as the residents of the county, our consumers, when they heard that we're in serious situation with regard to our budget and our financial stability, one of the rationales that I understood was used to justify that statement was that we did not account for this 27th pay. Is that your understanding as well?
The budget that I believe that the county executive, the issue that the county executive is speaking of concerning the operating budget, it does not. He's not talking about the 27th pay. We're talking about it would be a totally separate issue.
Okay.
The 27th pay, it's a one-time expense. It happens every 11 years. We've got sufficient cash to cover that, so it really isn't.
It's accounted for.
It's accounted for.
It is accounted for.
It's not an issue.
So I don't mean to grill you, but do you know whether the 27th pay issue was used as grounds to make a statement that we have a serious situation facing the county?
That is not my understanding, and
Okay.
that is not what at least that's not what I'm attempting to communicate.
Okay,
today.
not you. So the serious situation that was discussed at a press conference had nothing to do with the 27th pay. As far as you know.
As far as I know, it's concerning another issue. Which we will delve into.
So the 27th pay issue is a non-issue because we did account for it. It's in reserves. We knew it was coming. It's there, and it's going to be some kind of a wash at the end of the day when we figure out the actual dollars and cents, how much we need to spend.
Yes.
Okay.
Okay, Mr. Schron.
Yeah, I think Ms. Simon covered it pretty clearly with what I was looking to do, but from that same standpoint, did you ever raise that as an issue of seriousness?
For the 27th pay?
Yeah,
No.
as an item that that anybody needed to be concerned about?
No.
Okay,
And I would not.
Okay, and
Because the resources are the formal budgeting mechanism that does need to happen, correct. But the resources for the expenditure are in our available balance. We've planned for them. We haven't used that cash for another purpose. It's sitting in there in your balance right now.
And do you accrue for that 1/11th every year? I mean, that seems to be the logical accounting function you would do.
Normally, yes. Now,
Do we do that?
It looks like
we do that?
in the previous years. In the past couple of years, we've only reserved $500,000. But I'm assuming I'd have to go back and look. I'm assuming we've been reserving $1 million for the balance of this time period each year.
Okay, you've been associated with this department for how long?
20 years.
And so, and you're now coming into the leadership role, and you're saying you're assuming that we've been doing that for 1/11th for this amount?
That would be the
Why wouldn't we know that? I guess
Well,
I'm just a little disappointed that
I'd have to go back and look at the budget schedules to see what we in fact reserved. But I can tell you that the $11 million for this expenditure, and that's an outside number. That's the most conservative number possible.
I can understand accruing for more money than what perhaps, and then you can make the adjustments. You can true it up whenever the time comes. But I'm concerned when you say, "Well, I assume we were accruing for $1 million." I would have thought that would have said, "This is what we do, and we accrue for $1 million, and you can take that to the bank," as the old phrase.
I can certainly show you in the budget schedules that we've done so.
Because I remember when Mr. Miller was chair of this committee. This was not this was a new concept that came to us as council members, and we those of us in the finance committee. This was brought to our attention, I think, within the first year's budget where we discussed this, and we said, okay, as long as we're truing it up and we're having a clear understanding. It just always bothers when it looks like somebody else is surprised when it should not be a surprise to anybody.
I agree, and this situation is not a surprise.
Okay, so any attributes, anybody attributing this is something that they definitely, within your department, having been there as long as you have, and anybody else working in that area would clearly understand that was part of it.
Yes.
Thank you.
Okay. So let me So let me try to rephrase this before I do that, Mr. Brady.
Thank you, Mr. Chairman. I just want to make some brief remarks about this first item and the first topic, because it's something that people that have been with the county for quite a while, over the last 2 weeks since the press conference, I've had an opportunity to check and recheck that it's never been a question in anybody's memory about whether the county was setting aside the money for the 27th pay period, and this has gone on for many decades. So first there's that. The problem here, part of the problem here is a disconnect between what was presented in a press conference to the major newspaper of this town, and went out over the internet and is seen by those who are interested as reliable information. It is in fact the case by any reasonable person's estimation or observation that too much was made of this point. It was one of the major points that the executive made in his press conference. Whether you consider it to be something that was emphasized or not, when I read what was said, this was one of the major points that the executive made. He was in error. He was in error. And I find it disconcerting that he could have been in error, which is over what is not an insignificant amount of money, over an issue that is not difficult to determine. We were able to determine the facts within a few hours. So we're put in an uncomfortable position of having to point this out, but we want to make sure that we do. I find it a little disturbing that that apparently you had nothing to do with the conclusion that some people came to about this particular topic. That's the statement. You don't need to respond to me.
Well, I just want to make my point when you've concluded your comments.
I'm concluded.
Okay. I think again, what we're looking at, we're talking about two separate reports. If you look at the prior year actuals report for 2014, which I believe I've submitted to council, you will see that the original budget plan for the reserve of 27th pay for that particular year was $500,000. The budget, the balance for the ending year of 2014 is $200.1 million, which you will see mirrors the general ledger balance. It is implicit, at least to those within the office, that the $11 million for the 27th pay is in that particular balance. I think what will happen going forward is you will see perhaps a slight alteration or separation of some of these cumulative balances that we are planning for. I think you'll see them in a separate report, and so that this discrepancy per se would not become an issue going forward.
So let me ask you this. So you're referring to the report that we received on March 30th.
I'm referring to the
Exhibit 3.
Do
you not have those?
Is it if it's the remaining? If it's the 2014 results of operations? Yes.
Where it has the actual. Right.
So I think what we're talking about here is the central point is the $11 million is in the 200. It's in the $200 million. budget Exhibit 4 has a projection column where we show the accumulated $11 million balance. That column does not appear on the 2014, the 2014 year-end results of operations. So I think that's where
So let me ask
some
you this.
differences in our reporting. We're going to have to make some changes as to how we're seeing it, how we're showing it. But essentially, the $200 million encompasses these reserves plus what the county has left over in terms of cash.
The county itself made a policy to reserve, to say $11 million, whether it's $500,000 a year or up to $11 million.
Mm-hmm.
And that was a policy that was reiterated and stated from January 1 of 11 when we reviewed various budgets. We always saw the $11 million or $500,000 a year and it accruing. Why, if I can understand in a non-expense year that 15 is, so in a non-expense year where you're driving with that point, why then was that 11 million or whatever it had accrued up to on an annual basis not included in the carryover encumbrances? Because you're right, is it in the 200 million? Yeah, it's in the 200 million. We know it's there and there's a demand on that, but the carry-on encumbrances, we know that we've been historically reserving and have been practically reserving for that. Why was it not included in the carry-on encumbrances?
The carryover encumbrances.
Carryover, right.
The county has historically defined carryover encumbrances as legal obligations that have not ended in a calendar year, but are still in effect that we need to carry forward into the next year with the presumption that we're going to continue with those operations. The carryover encumbrance is normally tied to a contract or a purchase order, something of that nature. We've never classified it as we never classified the 27th pay as a carryover. It's a reserve on balance. Now we can certainly talk about maybe going forward, perhaps a formal documentation of the reserve, which would be through an appropriation measure. That's one of our options. That is something that we're going to explore and bring back to council at the appropriate time.
Okay, so I'm going to put on a cash accounting hat, not an accrual accounting hat. And I just want to restate this. In any of the 2015 budget items we've ever seen, you're telling me that the 27th pay has never been reflected.
In the budget?
In any roll up, any document we've ever seen, the 27th pay has never been reflected.
No, it's the reserve, but the reserve has been reflected.
But the expense had not. So
no.
So the county has. I'm going to be careful in the words I use. So the county has been underreporting expenses. You know there's going to be a 27th pay, whether it's 8.5 or 11 or some number in between. We know, and we have known, and every 11 years we know that there's going to be a 27th pay. And the information that's consistently been presented to this council in order to do its job in reviewing and providing financial guidance and controllers of the purse strings, however you want to reflect it, has never properly reported its expense scenario to the council.
It's reported 11 years ago. It shows up as a actual expense in the given year is paid out.
Correct, but when you're doing your budgets and you know that in 2015 you're going to have an expense, it should be reflected. I'm not meaning you, Chris Murray, personally, but you know OBM knows that number needs to be reflected. And in every report we've ever seen, that number has not been reflected. The 27th pay as an expense item, as an actual cash out. Because if I take these numbers right now, even if I take the March 30th, number, or the report off Exhibit 3, I'm going to have to add $8.5 to $11 million worth of expense to the let's look at Exhibit 4 because Exhibit 3 doesn't have a 2015 number on it. Exhibit 4, I'm going to have to add $8.5 to $11 million to the $334 million in operating expenses. Because my point is, I'm not talking, forget the cash. The cash is an issue. To me, the cash, we agree the cash has been sufficiently accounted for, reserved, set aside. But from a P&L perspective, from a profit and loss perspective, we have underreported expenses because this P&L, so to speak, does not include all the expenses that we anticipate in 2015. Is that correct?
That is one way of looking at it, yes.
Okay, all right. Any other questions, Ms. Simon?
I just wanted to follow up. I thought Mr. Murray answered that the reason it wasn't reflected in expense was because he was waiting to definitively reflect what the actual numbers would be in 2015.
Yes.
Mr. Greenspan? I think the question was asked and answered. I think he answered the question why it wasn't in our 2015 operational expense was because he was waiting to find out what the actual number would be to reflect reality versus an estimation. But when you say the proper way to prepare a P&L, I'm not sure there's one proper way. There could be different ways to account for this. So I think Mr. Murray answered he was waiting for a concrete number to put in our 2015 expense column.
Mr. Germana, do you have a question? Then Mr. Schron.
Mr. Chairman, I just want to say that, my prior life, I had 19 years at the city of Parma, which is the second largest city in Cuyahoga County. And we're very familiar with the 27th pay because it's a big issue in the city, especially if the city doesn't reserve. And I can tell you, early on when I was a new council president, the city spent money and they were trying to save, but when it came down to balancing a budget and at the end of the year, so they actually, back in the early 90s, there was at one time where the city had to go ahead and bond their health insurance just to have enough money to balance the budget. So since that time, our auditor in Parma, Dennis Kish, has been very disciplined with the 27th pay, and it's been reserved. And so we, in Parma, do not have the problem of this 27 pay coming up and then having to come up with something creative in order to pay it. So as I see it, and this is not on the finance committee, just came here because this is a big subject, I think we have adequate reserves. We knew about it. So I'm just questioning, like the Chairman Greenspan saying is, if we knew it was coming due in 2015, it seems like it should have been a separate item. But I got to give a lot of credit to Cuyahoga County because it's got great reserves on the general fund.
Okay. Mr. Schron, then Mr. Miller.
Yes, thank you. The 27th pay that comes in the 11th year doesn't just all fall in the 11th year. Is that a correct assumption? There's a piece of the additional pay that falls a piece every one of those 11 years, and we just pay it in the 11th year because of the accounting as to when it actually trues up.
My understanding of the 27th payroll is there within a calendar year, every 11 year we have an additional pay.
Yeah,
so we haven't. If I'm understanding your question, we haven't paid anything that was not a legal obligation or a payroll. No. We're setting aside the cash in the balance to account for the pay when we need to expend it.
I'm just suggesting another alternative to what Mr. Greenspan is. The cash is only going to go out once every 11 years.
Correct.
The expenditure could have been hitting 1/11 every single year for those 11 years.
Correct.
Because the expense truly is not hitting in the 11th year. The cash is hitting. The expense should be hitting, I believe, every one of those 11th years. It should be budgeted accordingly, and therefore it would not necessarily show all of the entire pay being an expense in the 11th year. And it seems to me that that's a more appropriate way from an accounting standpoint, because a piece of that is falling into all 11 years out there. And I would suggest that as we go forward, we ought to look and see what is best practices in regards to this. I know that we've heard about Parma, but in the past, but the issue is not whether or not you reserve the cash. It's also how does it reflect as far as the bookkeeping and the accounting side. And I don't, in my personal belief, I think that you ought to at least look and see whether or not the appropriate accounting function should be to have a piece of that expense hitting all 11 years, so it never hits in just 1 year. The cash is accrued and being built up, but I believe that you'll find that is probably a more appropriate accounting-wise way to go about it.
Mr. Miller.
Mr. Chairman and my colleagues, I'd like to make a few general comments and then comment a little more specifically on the 27th pay. In his recent press conference, Executive Armin Budish did not directly criticize Council's work on finance, budget, and debt management. But I need to remind everyone that this Council started from scratch 4 years ago and built a strong financial foundation. For proper context, note that before we started, most people expected Council to provide no more than a 30,000-foot level review without really getting into the weeds, and we have gone light years beyond what people expected. Through Councilman Greenspan's leadership, Council created a legislative reserve policy for both the general fund and the HHS levy fund, and we passed legislation defining what information should be provided before initiating new programs. I then persisted for 3 years and passed legislation last year to create a formal planning process to use when we identify threats to maintaining proper reserve levels. We passed legislation creating a defined set of reporting requirements to improve Council's oversight capabilities. We did not always get all the information we asked for, but we made the very best use of the information we got. The idea to avoid new expenditures outside the biennial and second-year budget processes is not new. In 4 years, Council only initiated 2 such expenditures: the program to assist low-income people with hearing aids and the additional staff for the detention center. Following Councilman Greenspan's request, we also initiated the process of having the bi-monthly fiscal resolution identify expenditures that use reserves. Last year, we ended the practice of giving blanket approval to year-end budget amendments. We now require all budget amendments to be approved in advance. The idea that we are facing debt policy constraints is totally not new. Last summer, I grew concerned about debt capacity and that we were receiving appropriation requests for projects one at a time rather than a comprehensive plan. I called a dedicated meeting of finance and budget, had our financial advisor, Mr. Sprague, advise us on our debt capacity, and called upon OBM to present a comprehensive plan for the next several years, which they did. I then said that we are reaching the limits of our debt capacity and that we need to plan well so that we don't fund a project and then leave us short when a more important one comes along. I also said that we are at a special time with opportunities to make progress that don't come along often, and that we need to stretch ourselves to take advantage of them. I still believe that. But recognizing our constraints, we acted cautiously last December and took $51 million in projects from the proposed $153 million main bond sale request. I don't want to get into the weeds on the new debt capacity modeling, but let me just say one thing, because it amounts to $78 million. The $100 million Western Reserve Fund was a public relations concept. We've spent about $22 million. How much more we want to spend is up to the executive and us. Mr. Executive, The problem with our debt capacity is not primarily financial, it's spiritual. If we dwell on what we are lacking, results will be lacking. If we think about what's possible, much will be accomplished. We have things in the wrong order. We should start by having you recommend what projects really need to get done and how much they will cost. We will find a reasonable and prudent way to get it done. Now I turn briefly to the 2015 budget. I've not seen a 2015 update, but I just don't think there is a serious structural problem. Council did a careful review when we passed the biennial and again when we did the update last year. Yes, there are presentational advantages to reporting the 0.25% sales tax separately. However, that money is not restricted. Money not needed for the 3 primary projects may be used to help balance the budget, at least for debt service. To think otherwise is overly conservative, in my opinion. It is also not correct to charge the entire cost of the 27th payroll against the 2015 budget. 1 year's prorated share should be charged. The rest should be funded from what we reserved. With those reasonable assumptions and the normal rate of attrition and unspent contracts, the 2015 budget will balance. There are some things I don't do well, but I am good at arithmetic and have an intuitive feel for numbers. We passed a prudent 2015 budget that can be balanced with reasonable effort. Going forward, I'm fine with being fiscally careful. At the 2014 to 15 biennial budget hearings, my recommendation set was the lowest cost by several millions. We've provided a good balance of serving the people's needs and being financially responsible. We started from scratch 4 years ago and built you a strong foundation on both capital planning and operations. Any other interpretation would be wrong and unfair. My comment regarding the 27th payroll is that when I try to think about how we're doing, I think in terms of a normalized year's receipts and expenditures. So along that line, we should only count 1/11 of the 27th payroll as what would be a normal operating expenditure for the year. Along the same line, I think that in 2014, we cut off expenditures early and we carried over an unusually large amount of encumbrances into 2015. And as a result, I think that probably our expenditures for 2014 understated what would be a normal year's expenditures, which partly explains why we had a $12 million surplus. And our expenditures for 2015 may be a little bit overstating what would be a normal year's expenditure because of all those carryover encumbrances. At the appropriate time later on, I'm going to want to ask some questions about exactly what the assumptions are going into the statement that was made that we have about a $15 million problem for 2015. We haven't seen the numbers yet, but I'm going to want to look at that in some detail. Thank you very much, Mr. Chairman.
Thank you. Ms. Conwell?
Through the chair to the director, the $11 million that was reserved for the 2015 27th pay, but in the 8.5 million stated in the debt cash flow model, what happens with the remaining usage of the 2.5 million? So if you said 11 million, that's what we estimated. but now you're kind of saying it's going to roughly come out to 8.5. What do we do with that 2.5? Do we utilize it to start saving for the next 11th year, or does it just stay in the general fund and used for other things?
Through the chair to Councilman Conwell, the $8.5 million is reflective of a January payroll snapshot. So January payroll forecasted for 27 pays, the impact is essentially $8.5 million for the general fund. The $11 million, I believe that is including some of our other special revenue funds. It's also including I think it's probably an old number because our operations, the 11 million is an old number because it's based on operational capacity that we don't have anymore. We don't have the same number of employees. So that $11 million, we've kind of kept that as a placeholder and lower for a number of years. I wanted to use the most current payroll projection I had at that point was a January month end. I annualized that amount for the general fund only. That's how I came up with the $8.5 million. So will there be some savings there for the county? It is quite possible that it will be, but I would not want to sit here and bank on or tell you to bank on a forecast based on January's pay alone. The office is right now in the process of completing our first quarter review. That takes 3 months of data plus interviews with department heads, and once we've had a chance to do that, to complete that work, then I would have an even better estimate for the $11.5 million. I'm sorry, for the $11.5 million for the 27th pay. Sorry.
So in moving forward with the $11 million that you said, that was an old kind of budget accounting.
Mm-hmm.
Do you think that the county would still keep that $11 million because you still have positions that haven't been filled, whether they are or not in the future? They haven't been, and we want to be, I guess, be over than under.
Well, that is one of the reasons why I didn't want to include a 27th pay in the budget. It was because I wanted a more exact number. This comes along once every 11 years. So a additional payroll based on the most current activity that I had, I thought was a better basis for bringing another appropriation measure to council. So that was my plan. That was my goal. I believe that was probably a little bit more of a conservative viewpoint.
Is that stated anywhere in our 2-year budget?
The fact that we
do not show or reflect in the previous year's budget, in 2014's budget, that we have the expense of the 27th pay.
The expense is not there. The impact on the balance is.
So I guess the council going forward is going to have to decide if they want to be open and transparent with that particular item on the 11th year.
Right.
Okay. All right. Just to sum it up, unless there are any other questions, the overarching cash flow position is the county has the cash flow to meet this obligation.
Correct.
The county has been reserving $11 million for the 27th pay.
Correct.
The administration, I'm not being specific to anyone, an administration prior to this one, if I can so bluntly state it, presented a budget to us that did not reflect the full year's expenses in 15, meaning the 27th pay was not included as an expense item for whatever reason. If you truly want to go conservative with it, if you're reserving 11, then you should reflect 11 as your payout, and then you do an adjustment, which we do frequently, to true up what the true expense is. So the bottom line on the total expenditures is our total expenditures in 15 is currently understated by whatever amount the 27th payroll will be, whether it's $8.5 or $11 million.
Currently, that is a true statement.
Okay.
It will be reflected in the current budget once we've appropriated it.
Correct. But that's correct. But the budget we approved in December 13
Correct.
understated expenses. Okay. Any other questions on this subject? Okay. Hearing none, we'll move on to topic 2, which is the 2014-2015 biennial budget. Question number 3, I believe, has been addressed once we receive the March, where the $200 million came from, the $200 million in reserves. If you can move on to, unless you have anything to elaborate or anybody has any questions on that, we now see where that $200 million comes from on Exhibit 3. As I said, at the time we compiled that, we didn't have that, but question 4A, if you can address that one, please. Question 4A basically says that we had a surplus on the Q3 2014 projections of 100,000, yet the 2014 actual was 12 million. Why is there such a big difference?
Okay, the $12 million, so we're talking about the operating results of 14, the year-end revenue compared to the year-end expenses.
Correct. So if you look at the December Exhibit 4, said we would have a $74,000 surplus. That was the last projection we received for the year. Yet the actual that came through on March 30th had a $12 million surplus. Okay. So what happened between December and March that we had a huge swing in a surplus? Okay.
And I'm just gonna read off if that is okay. I'm gonna read off the response that I gave you. Essentially, actual revenue exceeded the third quarter estimate by $7 million, primarily due to a number of factors. Number one, the estimates that we use for growth in sales tax were 3%. The actual growth in sales tax revenue was 3.9%. So that was a conservative revenue estimate, but I always rather be low on revenue than high on my expectations. There's also better than expected sin tax collections. Sin tax collections were not budgeted, but we were made aware of them for mid-year projections. I believe my estimate was $7.5 million. We actually collected 10. Now, what is still unclear yet is, was that merely an acceleration of our revenue collections that we should expect for 14 and 15? That still needs to be determined, but essentially we received about $2.5 million more in sin tax revenue collections. The indirect cost reimbursement, which is it's a county revenue source. Well, essentially, indirect cost is the mechanism that we use to reimburse the general fund for services performed by general fund entities to non-general fund agencies. Councilman Simon, you remember this discussion that we've had. Essentially, the cost of providing legal services to the law office, payroll services, risk and property, all financial, the entire fiscal office, those are costs that, those are services that are provided to non-general fund agencies, primarily your health and human service departments, and we have some other special revenue funds. Those services, we charge those particular entities 2 years after the actuals have been completed, and that's provided, that becomes a revenue source for the general fund. That is a standard revenue item for all governments of our size. It's called a indirect cost reimbursement. And then finally, there were a couple of other major points. There was growth in our public defender, our state public defender reimbursements, and the homestead collection, I believe, is about like $1 million higher than we anticipated. So the revenue growth, in conjunction with the lower than expected expenditures, significantly changed the balance in the general fund. The following agencies had lower than anticipated expenditures, and these you will note that these are pretty much the same entities that traditionally underspend: the fiscal office, information technology, the sheriff, and board of elections. So the county expenditures and their projection, of course, are materially affected by any projected vacancies versus actual vacancies, as well as the timing of contract payments by county agencies. OBM, we can provide any detail for each agency if so desired. Lastly, council should note that the countywide financial payments were suspended in November of 2014. So at this point, there is we are experiencing lower expenditures if you compare 2014 to prior years. Now that situation going forward would not be an issue if we continue the practice of essentially suspending financial payments in the middle of November. If we don't, then that's going to be, obviously that would not help us in terms of comparability year to year on expenditures.
Yeah, and Mr. Miller touched on that. That was a question I had as well. And since you raised it, I'll raise the question now. So in 2014, how many so the cutoff period prior to 2014 for expenditures to be paid in 14 was what, or in that current year was what, around what day or week?
We actually, we were, I would say, really toward the end of the year, like literally the end of the year.
So if let's say it was the 51st week of the year, all right, week before Christmas.
Okay.
Just what was it last year? In 14, what was the cutoff?
I believe it was the middle of November. Middle of November.
So around the 46th week. 5 weeks, 6 weeks earlier than.
Sure. Okay.
That was in 14. So in all other years except for 14, the cutoff date was say December 2020.
Essentially year end, yes.
Last year, it was shorter. The period was shorter, correct, by 5 weeks, 4, 5, 6 weeks. So, and understanding that extra week, that cutoff from 1 year would roll into the next, assuming you kept the calendars the same. So you're always paying 52 weeks worth of expenses in any one given year. It just may be 50 weeks of 1 year and 2 weeks of a previous year and 50 weeks of the current year.
Right, correct.
Except in 14. In 14, what I'm hearing is you didn't pay 52 weeks of expenses. You only paid, say, 47 because you cut off earlier in that year.
But we would have had expenses from 13.
Only 2 weeks or 1 week.
Carrying over.
A shorter period of time.
A shorter period of time, sure.
So let's say we had an historical calendar of payables in any 1 year comprised of 50 weeks of the current year and 2 weeks of the previous year to get your 52 weeks of pay. Except in 14, you had your 2 weeks carryover from 13, but you only paid out 44 weeks or 45 weeks of 14's pay. So in essence, we didn't pay out 52 weeks worth of expenses in 14 because you changed the cutoff calendar.
Because of the cutoff.
Right.
Right.
But we had 52 weeks of revenue, correct? Was revenue?
Revenue was not cut, as far as I know, revenue was not cut off, no.
So
as we collected it, yes.
So a fundamental tenet of accounting is referred to as the matching concept, match revenue with expenses. So we did not match revenue and expenses in 2014. Do we have any idea as to how that impacts the $12 million surplus in 14? Obviously, it's got to have an impact because we didn't pay enough expenses, but we reported a full year's worth of revenue and shorted on the expenses.
I'm going to say about $3.5 million of expenses from 14 rolled into 15. Now that I would like to verify that, but that's my recollection.
And I stated in this meeting that it was not our intent, and it's the intent not to be adversarial, be collegial with the administration, and this is not to do with this administration. My next question, but who made the decision to back up the pay date into mid-November from the end of December?
That was a recommendation by our controller and our fiscal officer.
Okay, all right. Mr. Miller?
As you know, we responded last year to the audit findings and changed the year-end budget amendment process so that we did not provide the pre-approval, and I think the change in the cutoff date was needed to enable that new process that we implemented last year.
That's true. The mechanism that we were traditionally in the departments traditionally dependent on was the year-end blanket resolution, which allowed us to make any normally council-approved changes. We could make them at the level of OBM, and then that allowed fiscal processing to continue through the end of the year. That with the adherence to some of the management letter points, we decided, the controller and the fiscal officer made the recommendation to move the processing back so that we had plenty of time to close the books and have all processing closed by December 31st.
So you're going to get back to us on the amount.
On the amount, okay. Would you like all funds and general fund?
Yeah, I mean, it's important to understand exactly what we're talking about, because obviously it will have an impact on 15's numbers. Whether that's contributing to the 15 million that's currently been presented or not, we'll find out. But if it's a contributing factor, we should have knowledge as to what that factor is, which then would explain why we have a surplus of that amount. Revenues don't match expenses. Let me go to Mr. Shaw and then back to Mr. Miller.
Thank you, Mr. Chairman. Short period returns are not uncommon as far as in accounting, but I've never heard of a short period where you don't have the expenses match the revenue. They're both designed to have the same cutoff period of time, and I understand that the audit perhaps accelerated the cutoff of the expenses. Was the audit recommending also that the revenue would be for a longer period of time?
As far as I know, the audit does not address revenue collection.
Does it make? I mean, does it make any?
As far as I know, but
does it make any sense that you would not have those two periods matching up so that we'd at least be consistent?
Well, I guess since we're operating on a cash basis, I think what we would be talking about would be, I don't know, maybe suspending wire transfers of sales taxes. I mean, I don't know if that would be prudent for the county to do. I mean, to hold it, have the state hold it for us.
No, not the holding as much as you have the periods matching up so the expense and the revenue coincide, so you don't end up having an artificial building up in that respect.
But I would certainly defer this to the fiscal officer, but my assumption would be that would be part of the accrual for the financial statement purposes, which is different than my budget schedules.
Okay.
But I think that would be addressed certainly within the financial statements.
Thank you.
Okay. Mr. Miller?
Mr. Chairman, Director, I would like if you could shed some light on the carryover encumbrance. I was surprised by a couple things. One is that in Exhibit 3, the carryover encumbrance is listed at exactly $19,154,631 in the 2014 original budget. In the 2014 current budget, and in the 2014 actual. And then in Exhibit 4, that same carryover encumbrance, the second last line in red, is listed at $8,351,296 in the 2014 OBM third quarter projection. And I'm wondering, first of all, about the 8 million versus the 19 million. And secondly, it would seem to me that the amount of carryover encumbrance would not be something that one could exactly forecast. So I was surprised why those three numbers in Exhibit 3 are exactly the same.
For the carryover encumbrance, this is, we traditionally show that $19.1 million. I believe that's the verifiable expenditure, the verifiable carryover amount as of the date that the budget is passed. If you turn to the Exhibit 4 and you see the $8.3 million, that is a live projection column. So that is a number that we are refining on a quarterly basis. When you see our first quarter report and our mid-year report, that number is constantly refined. So part of the process of the review is literally walking through the agency's contracts with them, contract by contract, and assessing how much of those legal obligations that are on the books, how much are you actually going to spend in a given year, and then any prospective contracts that have not occurred yet, may not even be before council yet. We also have to take a picture or create an estimate as to how much of those contracts are going to be expended in a given year. And that exercise is, we do that exercise because we want to give you accurate current projection, and by definition, in OBM parlance, the current projection is cash out the door. So there's 2 or 3 different buckets of information. We'll have OBM internally keeps a current projection, which is cash out the door. We also keep a total projection, which would include projected expenses, plus everything that is currently on the books, plus anything that is that we expect to be executed in a given year. That's a separate bucket. So there's a number of different buckets of information that we maintain. For the purposes of the executive and the council's review, we provide the one that we think is most coherent, which would be cash out the door. This carryover encumbrance is part of that cash out the door projection or forecast.
Well, Director, if the third quarter projection was $8,351,000, why is it then going back to Exhibit 3 that the 2014 actual, the third column from the right, reverts back to $19,154,631, and if it did go back up, it just seems hard to believe that it would go back to that exact number to the dollar.
Well, no, this is in actuality the same amount. So as of the end of 2014, we have an actual carryover amount. We can find that in the general ledger, and that is literally the amount of money left over in legal obligations, contracts, and such that are physically on the books. We keep, when you move over to Exhibit 4, we keep that as our starting point, but then we compare the starting point with what we think is our updated carryover amount. In this case, the carryover amount has decreased. So what that will mean is that in some cases the contract, we expect some contracts to be decertified and reduced. So, some of them we may have the expectation of payments in those contracts has changed. This quarterly projection number reflects our best estimate. Now, again, that number does change, but that's because of the work that we have to perform in conjunction with the department.
So, Director,
Departments, I should say.
You're saying that even in the final 2014 actual, that you don't adjust that number to reflect the actual amount carrying over, but you don't do that until you get to 2015. Is that what?
Yes.
Okay.
Any other questions? Okay, moving on to question 5 under the same topic, has to do with the roll-up that we received in December, projected in 15 a surplus of $3 million. Then the administration has come out in the press conference and said they expect a deficit of $15 million for 15, which obviously is an $18 million difference. But a couple of things that I want to ask about. Exhibits 5 and 6 are the required, per our code, notification to council of financial condition of the county. Mm-hmm. And in there, it basically says that nothing is materially different from the budget in the general fund and Health and Human Service Levy Fund. It's almost a consistent message from month over month, and even the last statement says there are no material changes to the projected performance of the general fund or Health and Human Service Levy Fund against reserve targets. So consistently, there has been in these reports that we received for representing January and February, basically we're getting the everything's okay sign, yet we get a statement from the administration saying, that we're in a $15 million deficit. Where's the disconnect? Why don't these two exhibits, these two reports back to council, mirror the statements from the executive in his press conference?
Well, there's a number of different reasons, but let me begin with one statement. The January and February projection updates, for want of a better term, is essentially, as of this date, do I know of any material changes to the budget as presented? Mm-hmm. In that case, the answer was no. So these are more of not policy statements, but that you say they're germane to the reporting requirements that OBM has. So when we move over to the $15 million issue, that's the difference between budget reporting, which is totally different, to long-term planning. Now, I would like to go into this report in some detail and talk about some of the assumptions that we have, if you permit me to do so.
Well, you're talking about the debt schedule.
The debt schedule, because the conversation about the serious problem is germane to the debt modeling.
So yes, we'll lead into that topic. We can skip topic 3, move to topic 4 on the agenda. That's not a problem. But I guess going back to my original statement, then are we just not to believe the information that's presented on the January and February statements? So are we not? Are things not materially different, or are they materially different? At this point, Councilman Greenspan, I can't tell you if they're materially different. A detailed revenue projection is normally done over at least 3 months of data, and then 6 months of data, and then 9 months of data. So based on January's and February's actuals, I would not materially change
the revenues or do I see a material change in the expenses at this point? But I will admit to you that the deep dive into this information occurs with first quarter.
So, okay, so then we shouldn't pay any attention to what was written and submitted to us in January and February.
I didn't say that.
Well, but they're conflicting with one another. We either have no material issues or we have material issues. So
well,
we got
the material issues are again. This is back to the planning document, not based on monitoring of the budget as passed.
So if I'm to interpret the January and February updates, then I'm to assume that we are trending. I'm to read into this that we are trending right along with where the budget, which projected a $3 million surplus. So at some point, I'm going to get one of these in 1 month. It's going to be kind of the holy crap report where things have gone off the rail.
Right. I guess the holy crap report would coincide with more of a quarterly projection than the month to month.
Okay, Ms. Simon.
Thank you, Mr. Chair. The disconnect that I'm hearing in this hearing is that I'm not sure that it was Mr. Murray's reporting that provided the information for a conclusion that we're in serious financial situation. There's a serious situation. So we're asking questions about the data we've been provided, and what I'm hearing is Mr. Murray standing by that data, and that unless there's a holy crap report or some forecast, that will be, I don't see that we're going to get the information we're looking for. So I would like to hear from the person or the entity or the firm that actually at some point gave us this forecast of a zero sales tax revenue projection. I don't think we're going to get what we want from Mr. Murray because his data he's standing by, and that doesn't give us a projection of serious financial situation. So where is this coming from?
Well, and that's where I believe we'll move into.
We need to go there, but I'm not sure this is the person who. Okay, so we're laying the foundation that the data we've been provided is sound.
Right.
I'm hearing that. So I'll let you continue on, but.
No, and this module, if you look at these topics the way they're geared, this topic was to deal with the fact that we had a budget that had 100,000, then we went to 12 million. Where's the difference? And now we're 15 the other way. So we're getting there. It's a cumulative building process. So. There's no objection to my colleagues. We're gonna, and if are there? Well, let me ask you this: are there any further questions on topic 2? Okay, Mr. Miller.
Mr. Chairman, Director, do you have a document that shows a projected $15 million excess of expenditures over revenues for 2015?
I have a planning tool that will discuss what some of the concerns that we have, yes.
Well, consider a public records request. I want to see that document. I want to see what the assumptions are that went into that. I think that the chairman's question was right on point. That the monthly reports indicate that nothing essentially has changed, and now it's being stated that we have a $15 million deficit. So I have to assume that the assumptions are different, and I want to see what's going on so that I know whether those are based on valid assumptions or not. For one thing, I alluded to it in my comments earlier. I'm wondering if you're assuming that the 0.25% sales tax is totally segregated and that none of that money can be used for general 2015 expenses, not even for debt service. That's not an assumption I would accept. So I want to see that document.
I can provide these.
Okay, thank you.
Thank
And
you.
Mr. Chairman, just one other thing in the way of a comment, which is that it's regarding the monthly reports. You know, when we wrote the legislation on the monthly reports, we specifically didn't require schedules or detailed financials and suggested that it could be a brief narrative. You know, and we know the detailed dive is done on a quarterly basis, but you're looking at payroll expenses bi-weekly, and you're looking at major revenue sources like sales tax at least monthly, and what we intended was for that monthly report to give you a chance to say, well, we know this isn't definitive, but we think there may be something moving in this direction or that direction, and to kind of give us a heads up on what's emerging, and so I'm just requesting that you use those monthly reports in a more robust fashion to try to give us some greater insight beyond that there's just the pro forma comment that nothing has changed. So I make that request as well. Thank you.
Mr. Strawn?
Yeah, just following up on Mr. Miller's, your assumptions must have changed someplace along the way, and so I'm looking forward to seeing those. One of those questions that I asked you, and when you flatlined the revenue at, I believe, a 3% flatline, I asked you, and by your smile, you remember the question.
Yes,
and the question is going to come back again, because now is it more appropriate to at least be thinking, not knowing when, but we know that the date will come that we'll have a recession at some point along the way. That'll directly affect revenue, and obviously it will trend on out. Are your assumptions now building in some kind of a less than flat 3% revenue assumption? Is that what I'm hearing?
That's a preview, but yes.
Okay, it's a preview. Now, are you also building in that there will be a dip at some point along the way, as other people forecast? Not knowing when a recession will occur, but knowing that we have a history going back for years and years and years to at least be able to see some trending out there, what its impact would be within a range of the high, the low, and the accepted norm of where we think it's going to be. Is your forecasting now building that also into a model?
It's a conservative revenue approach. I would not characterize it as a dip in the model.
Okay, is it still flatlining revenue for on infinitum?
At a certain revenue assumption, yes.
Okay, so it might be a different than 3%, but you're still flatlining.
Yes.
Okay, thank you.
All right, very good. All right, Ms. Simon, and then
Just quick. Why, Mr. Murray, are you changing now your forecast? Isn't that what I just heard?
For planning purposes, if we're talking about some of our major county initiatives, we are presenting a range of revenue assumptions, a broader range than when we originally presented to council when we brought forth the 2014 bond legislation, which I believe at one time it was just 3% sales tax increase and then 2% increase in expenses. So now we are presenting a range.
Why?
Well,
why now?
There's a number of different reasons, but which I can certainly go into. Are we going to move?
Yeah, I believe that moves. Yeah, that moves into debt capacity.
Okay.
Question. We start getting into future assumptions.
Which, by the way, Mr. Chair, I'm glad to move on. But we've already known about. I mean, Councilman President Brady said we've known about the debt capacity. We've known about the projects on the horizon. there's nothing new here, so I don't understand why now we're taking such a cataclysmic change and shift. That's all I'm saying. It's a statement.
Okay. All right. Any other questions on this topic? All right, hearing none. We're going to skip topic 3, move right into topic 4. And I believe Mr. Sprague came from Columbus to help address this issue, so I didn't want to not provide him that's not proper English. I wanted to provide him an opportunity to address some of the concerns that come up. So before us, we see question 1, which was one of the fundamental statements made during the executive's press conference, and one in which not only Council President Brady, but all of us over the years have expressed concern regarding the amount of borrowing and the ability for the county not to continue to borrow. We believe that there is additional capacity to borrow. The issue has changed, and subject to the ability to pay that debt back, the cash flow component of the borrowing. You know, it's a great analogy positioned to me when I was asked, why is this an issue? And the response was very similar to someone saying, well, the ability to borrow money should coincide with the ability to pay it back. Well, that's not always the case. And the analogy was, well, I get offers for credit cards all the time at home, and I can borrow up to $10,000 on a credit card. Yes, that's true, but the ability to pay it back is where the challenge lies. And that's the analogy, I think, that may be closely similar to the scenario we're in. It's not the ability to get the credit to pay, to do the projects, it's the capacity to pay the debt back. So, Mr. Murray, I'll turn it over to you. The questions before us under topic 4, it's also reiterated in Exhibit 1, and if you would go ahead and begin the presentation.
Thank you.
I must say, this document is this is already an exhibit to us, correct?
I believe it probably is, yes. It should be the 3.2.0.0. Yes.
All right. Just for my colleagues' reference, it's in our packages already as exhibit 10.
Okay. Thank you, Councilman Greenspan. I think before we delve into the parameters and the logic of the report, I'd just like to take you back briefly to the beginning of these discussions with council. And since I was in this particular chair as of January, I'm going to go back to maybe the June timeframe. There was a continual discussion with council, and one of the things that you asked the administration to provide was what is our debt capacity? How much does that allow us? What kind of room does that allow us to work with in terms of additional debt projects? And the answer at the time, and Brad, step in if I walk into a ditch here, but the two issues were one of were really what's your legal capacity, which is tied to our assessed valuations. And just to summarize, because of the assessed valuation drop that we've experienced within the county, we no longer have inside millage. We no longer have room under the unvoted debt or general obligation debt to issue any additional bonds until multiple years into the future. So we talked to our financial advisors who are in the room, Prism Municipal Advisors, and what we decided to do was build a long-term planning model based on the debt schedules that OBM has maintained for at least 20 years. So what we did was we tried to take we isolated what our operating expenditures are, what our operating revenues, which traditionally tend to grow between 1% and 2% depending on the year, and then we isolated some of the major expenses of the county, such as the headquarters lease, our non-geo debt, our self-supporting revenue, and we laid it all out in a spreadsheet document that I believe we discussed prior to November, which would have been right around the bond legislation coming before council. And then we would also show the impact of our revenue assumptions and our operating expenses, and then those fixed expenses like debt. What does that really mean to our ongoing general fund balance? Being cognizant of the fact that we have a policy limit, which no one really wants to see changed, at least not at this point. And then we also showed you what the assumptions would be on that general fund balance if we layered in the debt projects that we originally proposed to you late last year. That model is what you received. I have it as November 6th. Hopefully my date is pretty close. There's multiple iterations of this document, but this is sort of the basis. This is where we started in terms of our discussion of debt. And so each year, well, not should say each year, but the assumptions on the 2014 debt model were a couple of different things. One, it was 3% increase on sales tax, and that was based on our year-to-year growth in sales tax over the last, I believe, 4 to 5 years was a little under 4% each year. So that was the original estimates that we used in the model, and then for all other expenses, which would be property taxes, intergovernmental, local government, those we only increased at 0.25%, and then expenses were increased at 2%. Now, in that particular model, we carried out those revenue assumptions clear out into 2044, and as he's just reminded me, Councilman Sharon has indicated that it might not be we know there's going to be a dip somewhere, so that might not be the best way to move forward in terms of a planning document. So we've made some modifications to that. This model also, I'm still on the 1114 model. This model also assumed that the 0.25% sales tax continued. Now that is an assumption. It's baked into the model, but in terms of public policy, that decision has not been made. So you will see in the new iterations of the model that I just given you, we've made some adjustments to that model as well, to that portion of the model as well.
So just to be clear, that's Exhibit 8, which was the document dated 11/3/2014, which was presented to us at the Finance and Budget meeting on November 10th.
Okay.
That model included the 0.25% and included effectively an assumption, a premature assumption that it would, and I would argue a wrong assumption that the 0.25% sales tax would be continued through 2028 and beyond.
Okay. So moving to the March 2015 model, and of course, with models such as these, they're not budgets, but they are a planning tool, for want of a better term, to allow us to see, based on a certain set of assumptions, how much debt can we reasonably afford to take on? How are we doing with our existing debt? And do we have, are all the variables the same? Are we looking at the variables correctly? If you look at the two models that I've given you today, and they're in the exhibits, there's two sets of assumptions. There are two major assumptions to the model. Now, I'm going to go back to the 2007 sales tax that was passed by the county commissioners. As part of the financing plan for the structures, for the three structures, that way, my directions are bad. The financing plan included, for want of a better term, a virtual box around the debt service for the medical mart, the debt service for the convention center, the hotel as well. Those three structures were the financing plan, and those three structures were designed so that they were going to be covered by a specific set of revenues that the county is currently receiving and depositing in the general fund. So that number, if we include the 0.25% sales tax, the CV Convention Visitor Bureau bed tax, and the increase in hotel revenue based on the hotel building activity that we've experienced in the community. Those and one other thing, and the operating payments or operating revenue from the hotel operator. If you take all of those revenues, they are expected to cover the debt service for the medical mart and convention center, the debt service on the hotel construction, and the operating payment to medical mart. There is an operating payment to the medical mart that is within our general fund budget at this time, and it has been since we've been making this subsidy payment. So the assumptions that that box, for want of a better term, has been pulled out of the revenue estimates and expense estimates that you see currently before you. So that's about $52 million in expenses, and to date, about $36 million in expenses. Now that's going to grow. That's going to grow because at this point, the impact of the hotel is not reflected in 2015's budget. We won't see the impact until 2016. So again, when you pull out this revenue, that's $52 million in revenue that comes out of the model, and at this point, $36 million in expenses. The difference between the 52 and the 36 is the basis for the ongoing operating issue that you see under operating surplus/deficit column. Now, what this model, which both models show, again, is also the revenue and expense growth assumptions have changed. One, and they're labeled. There's a small box underneath the long table. The assumption growth rates are listed thusly. In one version of the model, the sales tax does increase by 3% continuously, and then the expenses increase by 2%. And then in the second iteration of the model, we have 0% growth on revenues and expenses. Now, the three green lines at the top of the report, those numbers are based on the operating budgets of the county that were passed. So the $389 million in expenses that the county, as part of our county budget, that has been reduced by the $36 million in obligations for 2015. The revenue of $389 million has been reduced by $52.5 million because, again, if we go back to the original financing plan, the three structures are to be supported by the revenue sources that I've outlined. So when you do that, we can certainly see that there is an operating issue of about 5% if you compare our operating deficit to what we're spending. So if you take the $15 million divided by the 389 million, we're essentially talking about around 5% in terms of a structural imbalance. Now, what I also wanted to let you know that if you look in the second, there's the long box and then there's the second box in each iteration. That second box shows the impact of additional borrowing on your general fund balance. I don't think I provided that. I can give you how the debt has been laid out in terms of potential debt payments, but that includes, just for the sake of example, that includes the part 2 of the sales tax bonds that were moved into 2015. It also includes $78 million in additional borrowing for Western Reserve. And there's a couple of other projects. I can certainly provide the detail for you. But those are the basic assumptions. Those are the basic assumptions that were laid out for this particular iteration of these two models. Now, I would also like to make this statement. Traditionally, the county has looked at our current year and maybe the 2 years afterward, the 2 future years afterward, maybe 3. But this planning tool that you're looking at, this is really the first. Last year was really the first time we took a look at our operations over the next 30 years, just to give us a baseline as to how we need to move forward with our public services and the resources that we have. And then I also want to make a couple of comments about the $14 million. The $14 million is that estimate. Sorry, 14.8. The $14.8 million is a function of budgeted expenses and budgeted revenue, irrespective of the 0.25% sales tax and the associated revenues and the debt service for the three structures. So keeping that totally separate, the $15 million reflects the budget as passed. Now, we know that there's a couple of caveats to this number. I've identified approximately $6 million of one-time expenses in the 2015 budget that once they are completed, those are not ongoing expenses. There's also
I can't leave you at that. What are these?
There's a couple of different things. I'm gonna have to go from memory. There's about 1 point.
Were they budgeted?
They were budgeted.
Okay.
Oh no, they were budgeted. $1.7 million for the 911 consolidation plan. There's
I can if they're budgeted included in these numbers, then we don't need to go continue.
Okay. Yeah, they are in these numbers. Also, as a historical precedent, we know that the county traditionally underspends its appropriation measure, and then this operating deficit is also reflective of my revenue estimates, which at this point, the revenue estimates for the budget are based on third quarter's projection. So again, I have to do a deep dive into our revenues for 2015. I know that there's always going to be differences in timing of vacancies being filled, contract payments. I mean, just there's always a difference between what I think is going to be filled as opposed to what actually the vacancies that actually occur. We always have people coming on and coming off. Is what I'm coming off our payroll. So I think the message that I want to give you is this is manageable, but the assumptions that we used at this point have to be based on the budget as passed. Now, I will tell you that I will go back and I will incorporate the quarter estimates into this model just so that we can see how well we're performing. But for the purposes of a February or early March meeting before we get a chance to do the first quarter report, I think the best, most verifiable numbers at this point is the 2015 budget as passed.
Okay, let me ask you some questions about some expense items.
Mm-hmm.
In the numbers you're using on the March 25th documents, regardless of the 3.2, just
mm-hmm.
the 15 numbers,
mm-hmm.
those expenses, that's 100% spend. It assumes 100% spend.
Yes.
Does that include any modifications to collective bargaining agreement increases, and is it a live number that's been modified as the county has renegotiated those types of contracts or amended other contracts?
That's an excellent question, Councilman. This number includes known union increases as of the budget passage.
As of December of 13?
No, as of because we update these numbers again for 15. So as of October, November of 2014, okay. all known budgeted increases are there. So okay. if we knew that there was a union increase forthcoming for next year, it's included in the base.
It's included and
in this number.
And was there an inflation factor? That's your 2% expense increase? Is that what you're talking about? As
in the budget, there's a 2% increase on some contract lines, some other expense lines. If an agency has significant contractual expenditures, say a board and care in Children and Family Services, normally we wouldn't provide a 2% increase there. Those tend to be negotiated.
Okay. So, you touched on it, and it's clearly worth noting when we're talking about just a roundup and to be consistent with the executive statement of a $15 million deficit, that with the expenses budgeted at 100%, we know, and Exhibit 7 points this out, over the last 4 years, we did an analysis of budget to actual to come up with a budgeting tool, so to speak, as to what can be anticipated as far as the county's annual spend percentage of total budgeted expenditures. The average expenditure percentage is not 92.6%, 92.5% of what's budgeted. If we use that as a model based on the budget that was approved at $334 million in expenditures, and it looks like you're using a 329 number, that's almost nearly $25 million in unspent expenses that were budgeted. And I agree you should budget 100%. Don't get me wrong. Where I think and I've had discussions with the administration about this in the past, putting a budget together is one thing. To modify it along the way, those are typically referred to as projections, which deviate from the original budget, so you can see what you thought versus where you are. We don't necessarily do that. I think it'd be a useful planning tool. But if you were to take that assumption at 90, take $25 million away based on historical. If you're looking at purely a projection on expenses, you can keep your revenue at 3 or at 0, and your expenses at 2 and 0. It's irrelevant. The actual spend to the budget is about $25 million less than what's in there. With that said, if you take the $15 million deficit that's been reflected here, it puts us at about $10 million surplus on a projected basis. If you take the 8.5 or 11, whatever the 27th pay is, into account on top of that, because I'm assuming it's not included in this 15 million, it puts
It's not in the 15 million, but it's reflected in the total general fund balance column.
It is. Okay.
It is.
So then it further bolsters my position that the county, in essence, from a projection standpoint, based on historical expense spend, with a 0% growth in revenue, could finish the year with a $10 million surplus, assuming a 92% expense spend. Look, we're talking projections. I mean, we're all making hypotheses.
We're making hypotheses at this point, yes.
So, but it's fair to say that we're not going to spend $329 million. We're going to spend less.
We may not. But I think the issue is we
never have.
The
last 4 years, we have never.
We haven't, right.
The highest we've ever come is 96.6% in 2012.
Now, Councilman, do you know if this is the original in your Exhibit 7? Mm-hmm. Is that the original budget, or is that the current budget?
These are the revised final budget expenditures versus actual. So we have exhibits 14, 15, 16, and 3. So presented in here to show where we pull these numbers from.
Mm-hmm. Well, I guess my only point would be that if I would show, we would show, I guess, the actual expenses to the original budget, because that current budget is modified.
That's what we've done. So
based on the carryovers and any program expansions that occurred between budget processes, which does occur.
And that's what we've done. If you look at Exhibit 14, which is on page 33, which is the 2011 actual spend to the 2011 budget, that's 92.3% of what was spent, which is indicative of the 4-year trend. So my point is, if you're looking at it from a projection, I get it. The budget, if you're looking at it purely at a budget, all in, all in revenue, all in expenses, doesn't matter if you're 3, 2, 0, 0, you're still talking about unspent expenses, budgeted expenses. And if you look at that on a projected basis, we traditionally spend 92.6% of what the budget is, which leaves in my example, it's a little different because you're using a little lower number, but roughly a $25 million, $24 million unspent expense, favorable variance to the profitability of the general fund in that year. And if what you're telling me is that the 27th pay is included in there,
in the calculation of the ending balance, yes.
So if it's included in there, then we could be looking at a high single-digit surplus, $1 million surplus.
So are we backing out some of the one-time expenses?
Whatever you're presenting here is your operating expenses is what we're using.
Okay, right.
In our example.
Then I'm with you. Okay.
So are we at least on the same page and understanding the strategy of this projection?
Yes.
As it relates to
the assumption is that we will spend under the appropriation. Yes.
Correct. And with that assumption, if we hit based on our last 4-year historical number, it'll be in the mid to low 20 million dollar range. The other analysis that we did, and we talked about revenue assumptions, whether it's 0, 0 or 3, 2, or 3 or 2 or 0 or somewhere in between, is we did another analysis just to kind of get a trending to see where we are. It's on Exhibit 11 insofar as judging our sales tax collections. This model on page 28, we did a 30-year sales tax trend. Obviously, it's been rumored that I'm a little bit on the conservative side, so I wouldn't use the last 4 numbers as last 4 years or 5 years as a number to continue to forecast, because we have had strong sales tax collections, and these have been adjusted to $1 million. We understanding that to 1%, understanding the increase in the 0.25% happened in 2007. But if you look historically over the last 30 years, the county has realized a 3.1% year-over-year increase in sales tax collections. So that in itself is an average, but it trends heavily in the last 5 years at 4.9%. Right. You know, we talked earlier in November about, you know, RTA and their economists using 2.2 to 2.5 and going to which is conservative based on historical, not only the near term but the 30-year historical averages. To assume that we're going to have zero growth is nowhere near even historically representative of what we can expect in the future. To Mr. Schron's point, if you look, you do see dips in sales tax growth and dips, you know, as we reflect on recessions, and you can look at, there are at least 5 years over the last 30, 1 in 6 that you see, although not trending 1 in 6, but 1 out of every 6 years you see a dip in the economy. But with that being said, even that over a 30-year model or a 20-year, well, this is a 30-year model here as well, to assume zero on sales tax alone, I mean, even from my conservative perspective, it's safe to say will never happen. And even on the expense side, if we're saying that we have some gross ups in here already on the expenses, factoring in inflation or where you know there are contract increases on the expenses, to assume zero on the expenses is not representative of what we can expect going forward. Now, who knows, as Mr. Schron said, what the crystal ball is going to tell on either side realistically. But, you know, you must use, maybe this is where Mr. Sprague comes in, you know, you must use some type of guidance when coming up with projections.
Thank you. I guess the direct question you'd like me to address is concerning the advisability of using 0% as a growth assumption, I guess.
Well, I think that's where, Ms. Simon, are we?
It's not so much the advisability, Mr. Chair, it's the assumptions by which we would, that we're carrying forward with zero. I mean, that's just based historically. There's no basis upon which I, as a council person, would think that's a realistic number. What are the assumptions? And then you can get into advisability based upon these assumptions that we go from a model in November to this model because we can have a range. But what assumptions are we basing this on? I'm sorry if that helps.
That's fine.
Well, I think it's safe to say that a variety of different scenarios were run under the guidance of the new executive, and at his request and things that he wanted to see, and one of those scenarios was to assume no growth in revenues, no growth in expenses.
Mr. Chair, but why no growth? I know you were told to run a number at zero, which is fine. We can project out zero, but what are the realistic assumptions that would corroborate or support such an assumption? I know what we were told, you were told, somebody was told to give us this model, but there has to be some assumption upon which this model would be based in reality.
I think the assumption was that since under that scenario, that if total expenses and total revenues were growing by the same amount, it almost didn't matter what kind of an assumption you put in, whether it be 1% or 2% or 3%, they're all growing at the same rate. So zero works as well as 1 or 2. I think the reason that the second scenario was shown, though, is to say, well, what happens if that's not the case? What happens if we put in something that's more historically reflective of what actually happens with sales tax? And that's why the 3% model was incorporated. In terms of whether there's a belief, I don't think that the executive expects there to be zero growth over the next 10 or 15 years. I think that as a starting point, he wanted to set that benchmark, and I think that's as far as it goes. Let's just what if, that's all. At least that's what I've been hearing. And that ultimate projections we buy into over time are going to continue to evolve, I believe.
Here, so we were given a number as a hypothetical that I have no evidence and there's no information that would support this assumption of zero growth. Then there's a press conference saying that there's a serious financial situation based, am I correct that the serious financial situation is based on zero growth? And maybe you two aren't the people who can answer that. Because right now we have this assumption out into the county and the residents that we're in a serious financial situation. And if that situation is based on zero growth, which we're now hearing is a hypothetical without any basis in reality, then I want to understand explain to me, is this the basis for the serious financial situation, zero growth?
I think, if I step back for a minute, number one, I wasn't at the press conference. Number two, I didn't participate in it at all. But the message I think is being delivered, and is that there's a lot of projects that are on the board moving forward. Some of them we know about. Some of them have been incorporated into the model, whether it be last November or whether it be now. There's a lot of other things that are surfacing on the drawing board, whether it be for Metro, whether it be for the Q, whether it be for whatever the other projects might be. And I think when you look at something like these spreadsheets, I never want anybody to read too much into what they say. And the reason I say that is because when you take something and go out 20 and 30 years, there's a couple of conclusions you can draw from looking at that information. Number one is, does it look like there's some years out there where we've got problem? And if we do, when we're issuing new debt for whatever project it might be, we ought to structure that new debt to avoid those years that we see as being problem years. In terms of the accuracy of information going once you go out 15 or 20 years, to me it becomes almost meaningless, because we don't exist in an economy that's going to exist in 20 years. This is a tool that I think you can have a lot of confidence in the first 3 years, 5 years, because they're based upon labor contracts that have been negotiated. They're based upon some level of comfort that you can have in what recent history has done, and that it's going to repeat in the short run. But to project that out for a 20 or 30-year period the mistake should not be made simply to put too much weight on that, that's all.
Mr. Chair, if I can continue. However, there was a press conference that said we're in a serious financial situation that rested on a zero growth assumption. And that's the issue. I understand that we can look out 30 years and we're not going to have a crystal ball. We can have realistic projections based upon history. And we have a history right now that tells us, at least liberally, that it's a 3.1 growth. And then to come at this with a zero, with no assumptions, you're telling me there's no assumptions in reality and history that would justify us resting or a press conference resting on a zero growth. That's the issue. So I want to know from either of you or whoever's in the room, is zero growth rate a realistic projection in the next, you gave us 30 years? Is that realistic that we're going to have a flat zero, it's less than flat? I just want a yes or no. Okay. Is that a realistic projection?
For zero for 30 years?
Yes.
No.
Okay. So
but the point of the model is this. We are the first three lines of both models assume the near future, and it assumes the basis of revenue growth and expenditure growth is taken straight out of the budget. The question becomes, in the future, will you grow at 2 and 2? Will you grow at 1 and 1? Will you grow at 3 and 3? Will you grow at 0 or 0? The further we get out from I think from Brad's point is the further we get out from 2017, it does become speculative. at this point. And the issue, the growth impacts, it impacts our capacity. The assumption on growth does impact our capacity for new projects. But the key here, and I believe what the executive is, the point the executive is making is that there are some, if you just take the budget as it was passed, there are some issues if we continue to increase the budget without corresponding revenue offsets. The $14 million is reflective of at least, let's be conservative, at least $6 million in one-time expenses. Those one-time expenses are not, they don't, by definition, they're not going to be an issue going forward. They are here. They are in these revenue numbers. I mean, they are in these budget numbers. They are real. The expenses are real, but they are one time. So the model is trying to isolate a static picture of expenses and revenues. How are we going? How does the county operate going forward with a certain set of revenue assumptions? And revenue is always the driver of what we should be budgeting.
I'll let you take over on the rest of this committee, but you're not. I understand you gave us a range. I said, and this committee said, we need a capital improvement and expenditure plan for the next 20 to 30 years. I said it. We all say we need that. But when we rest a assumption that we're in serious financial situation, do you believe that based on the current budget numbers?
I believe that we can prudently manage this particular issue. I believe we can manage it so that there is little to no impact on the operations. Yes, I do.
You think
because I know that that the projected expenses, what we actually are going to pay out, is going to be lower than the $352 million number that you see here.
I thought Mr. Greenspan took you through the expense, and I'll let you take over from there. But to say we're in a serious financial situation, resting on zero growth, resting on a calculated 27th payroll. So now you're saying the serious financial situation is only because of the expenditures going out, and we don't have the revenue to cover those that we've already budgeted? I'll let Mr. Greenspan take over, but this is making no sense to me.
Mr. Chair.
All right. One second, Mr. Miller, then I'll come to you. The primary, let's take the growth on the revenue expense out of it. The primary difference between these documents dated March 25th and November 3rd is primarily due to the fact of the segregation of the 0.25% sales tax and related expenses.
Correct.
When you put that in a separate bucket, this is what's reflected. Here's the challenge. The challenge is that when whomever stands at that podium and presents information to this council or presents information to the executive, we rely on that information to make our decisions. All right, it's not only in the financial world, it's on every committee. We hear people come and make statements that we challenge all the time. This is a very critical component of what we do in the county, is provide the financial resources to meet the fundamental obligations of the county. We made decisions based on a document that was presented to us in November, which had a couple assumptions that are no longer present, which if they were present at the time, may or may not have changed the direction, the way this council voted to adopt that budget. I can say this, it would have changed the way we adopted it one way or another. There would have been changes. The assumption of the 0.25% sales tax continuing on was a failure in judgment to continue with that assumption. Mr. Sprague, you said something to me that it is very concerning. And it's concerning because the fact that, as I just said, this council and the administration rely on information to make their decisions. The executive made his statements relying upon information, and you said that we should not read too much into these reports. That's a challenge when this is what we're relying upon to make decisions to help manage this county.
Well, let me try to clarify. What I mean, what I believe, is that when you get out beyond a certain time horizon, the veracity of the information you begin to question. I think that's true of any projection that goes out more than 10 years, because the world changes so dramatically. Do you want to see it to reach some general conclusions about areas where we may be having a pinch point, areas where we may be able to avoid issuing future debt? Yes. But all I was suggesting, and I do believe this, that once you get out past a 10-year, 5 to 10 year time horizon, the value of projections becomes less and less.
I don't think any of us would disagree with that. My interpretation of your statement had to do with the document that was before us, which is what the question was relating to, which had to relate back to the $15 million loss and serious situation the county's in, based on a report that was presented to the administration, to which the executive made statements which have raised concern in the region, not only in the county, in the region. When you look at the seriousness and the role in which Cuyahoga County, it's the 29th largest county in the country, plays in Northeast Ohio. And so when a statement is made that we shouldn't rely too heavily upon this, it calls to question, then what should we rely heavily upon in making decisions?
I hope I've clarified that, though, because if what I said earlier was incorrect, it was incorrect. But what I meant to say and what I believe is that as the farther you go out on this time horizon, the less faith you can put in something that's 15, 20 years out than certainly what you can do in the 5 to 10 year time horizon. Is 0% what's going to happen over the next 30 years? No.
I'm not looking. I'm just looking, to be candid with you, I'm just looking over the next 3 to 5 years.
I would answer that question and also say, from my personal seat, no. I don't think there's anything wrong with the executive requesting that somebody take a look at a zero growth assumption, if that's what he wants to see. And that is what he wanted to see. And I don't think that he would say that at the end of 5 years, when I look back, I'm going to see zero. I don't think he would say that. But I think what he was trying to do from where he sits, he wanted to see that as his starting point, and that's what we provided to him.
Okay, Mr. Miller and then Mr. Brady.
Mr. Chairman, Director, I want to get back to what you were saying about the virtual wall around the 0.25% sales tax, and if you look at Exhibit 3, where it has Global Center Operating Reserve, $11 million and a little more, and then on Exhibit 4 it has various numbers ranging from 11 to 19 million. Do those numbers represent the difference between the revenue and the expenses on the 0.25% sales tax, or do those numbers represent something else?
The Global Center Operating Reserve reflects the difference between the 0.25% sales tax, the 1% bed tax, and the Convention and Visitors Bureau revenue compared to the uses of the 0.25% sales tax, which are the Global Center, the Convention Center, the operating payments to the the Global Center, and the hotel debt service. So that number is fluctuating, but I can show you the basic accounting to that. And what we're doing now is the original plan was keep it in the general fund. I think where we're moving toward now is separating those dollars so that they can't be used for another purpose.
Mr. Chairman, Director, we asked about this particular reserve specifically during the last budget hearings in November, and there was no suggestion at that time that it would be imprudent to consider those revenues that were left over as part of the balancing the budget. What has changed?
Well, I can tell you the situation I inherited was the original plan was to leave these dollars in the general fund and try to segregate them virtually. Again, I think where the county executive would like to move to is we segregate those dollars so that again we don't get ourselves into a situation where we're counting on dollars that are earmarked or segregated for the purposes of the three structures. So I think once we made that segregation, we have an operating issue. But again, I will say again, the operating issue also includes the assumption of one-time expenses.
Director, on Exhibit 4, again, the Global Center Operating Reserve, these numbers ranging from 11 to 19 million, do those represent cumulative collections of the difference between the receipts and the obligations, or do those numbers represent the difference between the expenses and the revenues in a single year?
In a single year.
So you're saying then that for 2015, am I reading Exhibit 4 correctly, that that we're expected to have $19 million more in revenue from the 0.25% sales tax than we need to meet the obligations?
Yes.
For 2015?
Yes, assuming these basic revenue assumptions assume we collect based on these revenue assumptions, the answer is yes.
Well, that's a large amount of money. Why would we not model this that some reasonable amount of that 5 million would be held in reserve, of that 19 million would be held in reserve? Perhaps 5 or even 10 million of it, but that the remainder could be used to help pay our other debt service requirements. I mean, why are we all of a sudden, we're generating anywhere from 11 to 19 million dollars of excess reserve? It's just going to pile up somewhere. What are we planning to do with it?
Well, Councilman, I would refer you back to the original financing plan for the hotel. That original financing plan assumed approximately $43 million in general fund contribution. That general fund contribution is going to come from this excess that we're currently accumulating. So this reserve, it's an attempt to accumulate enough cash to cover that $43 million, but there's also we also have a capital reserve that we feel that we should start making formal plans for, so that those excess cash dollars at this point, that's where we feel that we should be using those dollars to cover those obligations.
Mr. Chairman, Director, how much money is currently sitting? If we had it segregated out today, how much money would there be sitting in the 0.25% sales tax that we have not had to spend on ongoing obligations that we have set aside toward that future obligation?
I only have 2011 through 14 in front of me, but that's $25 million. Currently sitting in the balance. Now I'd have to go back and pull the preceding years, but again, that money
I would
has to go to the as part of a use or source for the hotel project.
Okay, well, I would like two things. Number one is that I'd like you to go back to 2007 through 2010 and figure out how much is generated in those years, and to find out cumulatively how much we've obtained and set aside toward our obligation. The second thing is that I would like you to take just the 0.25% sales tax, segregate it out, since that's what we're going to do. I'd like to segregate it out and see a projection from now through 2027 as to what its projected revenues will be and what its projected expense requirements will be. And you can use any growth assumption you want, but just tell us what it is.
Mr. Brady. Mr. Miller, were you done? Mr. Brady.
I'm going to partly take a pass because it would be sort of out of context from what I was thinking before the councilman's questions. But let me just say then quickly, on following up on what Councilman Miller has said, that segregating out these numbers are, I don't think anybody has an objection to that. The point is that by focusing on this, like the 27th pay, was one of the few points that are focused on, as if this is some shocking revelation to the council about its budget. It's not. Members of the council know, even if they didn't segregate the money out, and we have no objection to that, we're not confused about it. And there is an impression left that somehow this is something that upsets the balance, the budget apple cart here in a significant way. And like the 27th pay thing, it does not. It doesn't. And so let me just say beyond that, because I'm out of context now, is that we've appreciated the advice that we've gotten from both of you gentlemen. I'm talking particularly Mr. Sprague, because we haven't seen as much of you for obvious reasons as we would our employee here. But when either of you tries to characterize what you think the county executive is thinking, when you're interpreting what you think the county executive means, well, that's helpful, but I don't know if you're qualified to do that or not, or if I'm qualified to do that or not. But because we're trying to just determine what the facts are here, and if we get too much into speculative conversations about what we think people mean by what they said or what they think they said, I'm just going by the information that I believe is not in question. Because I could sit here and speculate about these things as well, and I don't think it would be very helpful. So I'll pass on some of the other things I had in mind and try to help expedite the process here.
And I'm going to draw back to Mr. Miller's point. There was a statement made, reported in the Plain Dealer, regarding the quote is a one-time mistake last year in the use of sales tax money earmarked for capital construction to pay unrelated bills. And that was made by the executive. And I believe what he's saying is that of the 0.25%, the county spent some of the excess, the surplus of that revenue over related expenses on operating expenditures. However, well, is that statement true, Mr. Murray?
So you're asking me if I could comment on the statement made by the executive?
Well, did we use excess 0.25%, which is not unpermissible, by the way the previous county commissioners enacted that legislation. So there was no wrongdoing there. I think we would prefer to see it the way it's being currently proposed. But the statement being made that part of that 0.25% surplus was spent on unrelated expenses, when there are reserves in here for the Global Center, and it looks like our reserve went up during that same period from 187 million at the beginning of the year to 200 million at the end of the year. So did we use any of that 0.25% to handle unrelated hotel, convention center, or MedMart or Global Center expenses?
I guess it depends on the way you look at it, Councilman. The operating budget for 2015. In 2016.
No, but wait, let me back up. This says last year, it was specific. Last year, the use of sales tax money earmarked for capital construction to pay unrelated debts. So the statement was very clear. Last year in 2014, the statement was that a portion of the 0.25% sales tax was not inappropriately used. It could be used in this fashion, but was used to cover other expenses outside of I'll call it the three buildings. Because if that's the case, then I would expect reserves to go down or something to go down, and we had according to this, reserves went up.
Well, the reserves did go up because we collected revenue in excess of what was projected, and we've got the issue with cutting off financial processing. So again, expenditures are lower than we. So in terms of what was used, I mean, when you're talking about the general fund, there's a virtual box, but there is no physical box with these revenues. So property taxes, all of our revenue sources inevitably pay for what we expended in 2014. I can certainly show you that the 0.25% for what it's earmarked for, revenues exceeded expenses in our preceding years.
And that money's still available.
The money is sitting in the cash balance.
Okay, so whatever was collected,
we need to move it though, but
that's fine. But whatever was collected, less what was paid out
for the 0.25%.
The 0.25% was paid out for the three facilities is still available.
Yes.
Okay. Then the answer is the statement's not true. We did not use money last year for other projects because the money is still there.
It's an error.
Correct.
Mr. Chairman?
Okay. Yeah, Mr. Miller.
After you segregate this out, you said currently we've set aside 25 million and we're going to add 27 through 2007 through 2010 and
Correct.
see what the total number
Correct.
is. Once you segregate that out, is that going to reduce our general fund reserve balance by that amount and put us less ahead of our reserve targets?
Well, I think if by definition, if you moved out a significant portion of the cash in the general fund balance into maybe even a separate fund for the purpose of segregation, it will reduce your general fund balance. The question is, are you bumping up against your policy limits? And I don't believe that we would be close to them.
No, but it would.
It would change.
It would reduce the cushion.
It would reduce the cushion, not in the general fund total, but there's actually 3 general fund buckets. If we created another bucket for financial reporting purposes, it's still the general fund. We're going to segregate it in our reporting so that the checkbook that we use for normal operations is not impacted, or we don't.
It's still going to be part. It's still going to be part of the general fund reserve, but it's just going to be a different subcategory in a segregated account.
It's a different subcategory. And as a matter of fact, some of the reserves that you see on our reports, they actually are they're appropriate in a separate general fund bucket. I'm assuming that this will be the type of approach that we would move forward with for the purposes of segregating the 0.25%.
Okay, very good. Any other questions? If there are no other questions, actually, topic 3 was kind of rolled into this topic. I'm not sure we need to rehash unless it had to do with the 0.25% sales tax. Unless there are questions on that in particular, or if any of the committee members or members of council have any further questions, I'll just read a closing, kind of a concluding statement that I have.
Mr. Chair, before you
Ms.
close, I just want to say that based upon what I heard today, the reasons given originally for the statement that we're in serious financial situation have been dismantled during this process. The first was that statement was rest on an assumption of zero growth on sales tax revenue. The second one was that we didn't consider the 27th payroll in discussing or budgeting. Third, I think what I heard as well, that the 1/4 sales tax, I'm gonna come back, but I think there were 3 reasons given, and I think we've dismantled all 3. So I don't believe we're in serious financial situation. I think that statement had a negative impact, as the chair stated, not only on the county but regionally, and everything that we've worked for as council to just project a stable financial situation with our new county government, and all the hard work we've put into this is undermined, I think, when we recklessly make statements like that. I understand that we don't have money right now to do everything we need to do, and I think council wanted a plan to be able to handle the Justice Center and handle Metro and handle everything we had in a very methodical way. But when we do that, we need to base this on an assumption that's realistic and be able to work together to come up with a plan, a capital expenditure plan. We need to be creative. It's going to be challenging, but I think we can do it. We have to do it. Metro is important. The Justice Center is important. All of these projects are important to the county, and we all understand that this can't be done with a flip of a switch where we can just go ahead and budget recklessly. That's not what this council is about, and I don't think this administration is about that either. So this was a very helpful hearing today, because I'm relieved. What I heard is that we really aren't in a serious financial situation, which I don't think we were to begin with, but this just validates that. And I appreciate all the time everybody put into this.
Thank you. Mr. Brady.
Thank you, Mr. Chairman. I'll be quick since we're making some closing remarks here. I appreciate the job that the council, the chairman and the staff and others that have been involved have put into this work over the last 12 days. It was important, I think, that the council respond to the press conference, to the comments made by the executive. Having said that, we obviously know we need to work very closely with the executive going forward to meet the challenges that we have. I think the council has a record of doing that. When we learned not too long ago that we were going to be short on our projections of property taxes coming in, and we weren't that surprised by it, but Councilman Miller, as chairman in those days, had to really push quite hard for several months to get the administration to admit that we were going to have a shortfall, and then to admit that they had no plan to deal with the shortfall. This council unanimously faced that issue and did something about it. That was I think an appropriate response to that particular problem. What our challenges are going to be in terms of all these projects that maybe people didn't want to have to face 6 months ago, even though they were obvious to everybody in the council that they were there, is a different issue. But we have the courage, and we are secure enough in the experience that we've gained to be able to help the executive and work to meet any challenge that this county has. We are not afraid of the truth. Our problem is wanting to know exactly what the truth is, and not a version of it. And I know when we're doing financial projections, this is not, a perfect science, but we know some things, and we know that some of the assumptions that are made or that we're looking at are ones that I don't personally agree with. I don't think that it's a great radical difference between what I think and what's being presented, really. But there are some assumptions here. Obviously, the zero growth is one of them that no one agrees with, and so it is an exercise to use something that no one believes is a fact. It's not a conservative or liberal assumption. It's not a conservative or liberal approach to budgeting we're looking for. We're looking to do this in a way where we can rely on the facts and rely on the advice we get about what our borrowing capacity is, and then realistically make the decisions that we need to make and prioritize what we need to prioritize. And we'll be on this job for the rest of this year and into the budget season. But I just want to thank both the chairman and the former chairman and the other members of council and the staff for the work that we've put into this. So we're serious about this stuff. So in the future, maybe people should give some greater thought to what they have to say to the public, because we will respond. Thank you.
Mr. Schron and Mr. Germana.
Thank you. And I would like to reiterate both some of my colleagues' comments in regards to this, because I think we've rolled up our sleeves in the last 4 years. We've demonstrated a desire to do things like build in reserves into both the operating side and their health and human services. We even went so far as when the new found money that was going to come in from the casino revenue. This was a tough run, and this council wrestled with some tough issues, and we said no, we're not in favor of spending it immediately. We were in favor of building reserves and looking at it. We said if exigencies of circumstances caused it to accelerate, and guess what? The administration chose to do that and draw it down as opposed to letting it build up so we could have some impact. Well, we're faced with that again, and I know I had a conversation with then. The county executive-elect, and suggested we've got another round coming in, let's at least look at it. And fortunately, we still have that. That round is still in existence. It did not get spent, even though there was a desire to move that on an accelerated pace. So I think that if you look at our track record all the way through from the fiscal side of it, from the economic development side, we've tried our best to be good watchdogs and stewards for the funds. So when we hear that things are coming off the track, I can understand where all 11 of us, and that includes our predecessors who were there on our first 4 years, it's a sensitive issue with all of us.
Mr. Germana.
Thank you, Mr. Chairman. Just in general, I'd like to say that the reason I'm here, I'm not on the Finance Committee, but of course I've voted for all these issues, and I'm here to find out if we as a council made some bad decisions. And I think really, in my eyes, what I'm finding out today is the county executive, the new executive, was having some fresh eyes look at some projections just so he would have a comfort level with some fresh eyes. But I think I'm reassured that what we voted for was based on fact and information that was not fresh, because this county council, in particular the Finance Committee, gets into the weeds. I mean, there is great understanding of all these schedules, and I have a comfort level that we're heading in the right direction. And I understand that the county executive had some fresh eyes look at this. Now, before the next news conference, there probably should be some consultation with the Finance Committee. And that's all I want to say. I'm just relieved that, attending this meeting, I know we've made good decisions based on the information that we had in front of us.
All right, thank you. I'll just read this and then we'll conclude. I truly appreciate the county executive's genuine interest and thorough review of the financial status and debt capacity of the county. I believe this discussion in committee will assist both branches of government in coming together to help craft a long-term strategy that will keep the county's finances strong and healthy, all while keeping a historical perspective as the information that was relied upon to help us make policy decisions over the past 4 years. It's my expectation that the final report of this committee meeting will be compiled with the information disclosed today and will include questions that will be raised from this meeting, and the forthcoming answers will be included in that report. It's my objective that an agreed upon financial model between council and the executive will be developed to strategically position the county to maximize its resources and align the county in such a manner as to best serve its residents. Madam Clerk, has anyone else signed in for public comment?
No, Mr. Chair, no one has signed in.
I'll make a motion to adjourn. Is there a second? Second. Motion is made and second. All in favor signify by saying aye. Aye. We are adjourned. Thank you.